Warren Buffett, whose net worth reportedly exceeds $100 billion, epitomizes this philosophy. Transitioning from a modest beginning, where he peddled Coca-Cola door-to-door, to orchestrating the transformation of Berkshire Hathaway into a multi-billion-dollar conglomerate, Buffett, the Oracle of Omaha, has consistently ranked among the world's wealthiest individuals. Distinctively, he did not inherit his wealth, nor did he amass it through technological innovation. Instead, his financial acumen in the stock market has been the cornerstone of his fortune. What then is the secret to his extraordinary success, and how has he outperformed where many others have faltered? This exposition seeks to unravel the methods by which Warren Buffett conquered the stock market and ascended to the zenith of self-made investment billionaires, beginning from his earliest days. Born in Omaha, Nebraska in August of 1930, a year after the onset of the Great Depression, Buffett witnessed firsthand the struggles wrought by this severe economic downturn, thus gaining an early appreciation for the value of money. His father, an astute businessman who had recently lost his banking job, utilized his limited savings to establish a company dealing in stocks and bonds, thereby sustaining his family. Warren, a reticent and introspective youth, spent much of his childhood engrossed in reading, particularly from his father's collection of books. It was in these formative years that he developed a fascination with investing and the broader world of business. Seizing the opportunity to apply his burgeoning knowledge, he approached his grandfather, the proprietor of a local grocery, seeking beverages to sell around the neighborhood. At the tender age of 6, Warren commenced his inaugural business venture, vending Coca-Cola door-to-door, earning a modest profit. By age 11, Buffett invested all his savings in his first stock purchase, 3 shares of Cities Service, an oil and gas company, at a $38.25 per share. Although the stock initially depreciated to approximately $27 per share, Buffett held firm, eventually selling at a $40 per share. Despite realizing a profit, he observed that the shares later surged to over $200, a lesson that underscored the importance of patience in investing. Buffett has often remarked, "75 years have elapsed, and I've never been able to predict the market's behavior on the following day. My expertise lies in recognizing whether I'm investing in the right economy and holding on to commendable companies for extended durations." These early experiences and missteps significantly contributed to Warren's precocious financial wisdom. As a teenager, Buffett's father was elected to Congress, prompting the family's relocation to Washington, D.C. There, Warren secured his first formal job delivering newspapers for the Washington Post. Dissatisfied with his earnings, he also undertook a concurrent delivery job with the Times-Herald, amassing just $179 monthly, equivalent to over $3,000 today. Buffett later invested his savings in a pinball machine, partnering with a friend to install it in a barbershop. Their venture expanded to 3 machines, and they eventually sold the business for $1 and $1,200. Remarkably, at just 15 years of age, Buffett used these proceeds to purchase a 40-acre farm in Nebraska. Upon graduating from high school in 1947, Buffett aspired to commence a career in stockbroking. His father, however, encouraged him to pursue higher education. Consequently, Warren enrolled at the University of Pennsylvania, financing his studies with income from his Nebraskan farmland. After earning his bachelor's degree in business administration from the University of Nebraska, Buffett applied to Harvard for his master's degree but was rejected. This seeming setback proved fortuitous, leading him to Columbia Business School, where he encountered Benjamin Graham, a pivotal figure in his life. Graham, an economist and investor, profoundly influenced Buffett. They met in the same year that Graham published The Intelligent Investor, a seminal work delineating a methodical investment approach, eschewing speculation in favor of acquiring undervalued stocks. Buffett excelled under Graham's tutelage, absorbing the principles that would form the bedrock of his investment strategy. Post-graduation, Buffett yearned to work on Wall Street, but his introverted nature and lack of self-confidence, manifesting in severe nervousness and anxiety, posed significant barriers. Undeterred, he enrolled in a public speaking course, a decision he later cited as one of his best investments. Shortly thereafter, Graham offered Buffett a position at his investment firm in New York, an opportunity Buffett eagerly accepted. At Graham's firm, Buffett honed his skills in security analysis, gaining insights into discerning a company's true worth from its financial statements. While Buffett and Graham shared mutual respect, their investment philosophies diverged. Buffett placed greater emphasis on understanding a company's operations and believed that management quality should inform investment decisions. In contrast, Graham focused primarily on financial metrics, favoring a more formulaic approach to investing. In 1956, following Graham's retirement and dissolution of his partnership, Buffett returned to Omaha with a $175,000 in savings and invaluable experience from his tenure in New York. He established his investment partnership, Buffett Associates Limited, commencing operations from a bedroom in his house. He persuaded friends and family to invest a total of $105,000, kickstarting his venture. Buffett's initial investment strategy, heavily influenced by Graham, involved acquiring undervalued stocks, particularly those of companies nearing bankruptcy, bought at such low prices that their liquidation value exceeded the purchase cost. This approach, which he termed cigar butt investing, was predicated on the notion of finding severely undervalued stocks that, even in their deteriorated state, offered a final puff of value. This strategy proved remarkably successful, and over 6 years, Buffett's partnership grew from a $105,000 endeavor to a $7.2 million enterprise. However, Buffett faced skepticism due to his youthful appearance, which belied his age and expertise. Many potential clients hesitated to entrust their investments to someone who appeared barely out of his teens, despite his burgeoning success. Nevertheless, those who did invest with him reaped substantial rewards, with the partnership achieving an average annual return of 29.5% from 1956 to 1969, significantly outperforming the stock market. By the mid-1960s, Buffett was managing over $44 million in assets, and by 1969, this figure had escalated to an impressive $104 million. Yet, amidst a booming stock market, Buffett grew concerned about the escalating stock prices, fearing an imminent market correction. Adhering to his investment principles, he decided to dissolve his partnership, returning the capital to his investors. By this time, he had amassed a personal fortune of $25 million. Buffett's next venture involved transforming Berkshire Hathaway, a floundering textile company, into a billion-dollar empire. Initially, he invested in Berkshire Hathaway as a cigar butt, purchasing shares at $7.50 each, below their asset value. However, after a contentious interaction with the company's owner, Buffett took control of the company and gradually steered it away from textiles, repurposing it as a holding company for his investments. This decision marked a pivotal shift in Buffett's investment strategy, influenced by his business partner Charlie Munger. Munger advocated for a shift from acquiring average companies at bargain prices to investing in outstanding companies at reasonable prices. This revised philosophy led Buffett to seek companies with a sustainable competitive advantage or an economic moat, which would enable them to maintain market dominance over time. A prime example of this approach is Buffett's investment in Coca-Cola, a brand with a century-long history and a global presence, making it difficult for competitors to challenge its market position. Applying this new strategy, Buffett began acquiring significant stakes in top-tier companies like American Express and The Washington Post through Berkshire Hathaway. By the late 1970s, Berkshire's stock, which was valued at $11 per share in 1965, had soared to over $290. Buffett's net worth concurrently grew, reaching approximately $240 million. Another critical element of Buffett's success was his foray into the insurance industry. Recognizing the parallels between insurance companies and banks, with both having substantial cash reserves from regular premium payments, Buffett saw an opportunity to use these funds for strategic investments. Starting in 1967, he began acquiring insurance companies, including National Indemnity and Geico. Leveraging the capital from these acquisitions, Buffett made astute investments in companies with strong economic moats, further expanding his portfolio. One of his most notable investments was acquiring a significant stake in Coca-Cola, contributing to a dramatic increase in Berkshire Hathaway's portfolio value. By the 1990s, Berkshire's stock was trading at around $7,000 per share, and Buffett's net worth had surpassed $1 billion. Throughout the years, Berkshire Hathaway has continued to invest in leading companies, including major financial institutions like Goldman Sachs and Bank of America. This strategy has solidified Berkshire Hathaway as one of the world's most powerful and profitable corporations, and Buffett as one of the wealthiest individuals. Despite his immense wealth and success, Buffett is known for his frugality, exemplified by his modest lifestyle, including driving a 2014 Cadillac XTS and often eating at McDonald's. His approach to business and investment, grounded in principles and integrity, has established him as a paragon in the field. Buffett's profound understanding of the intricacies of business and investment has set him apart as a singular figure in the financial world. In conclusion, Warren Buffett's journey from a young boy selling Coca-Cola door-to-door to becoming a self-made billionaire investor is a testament to his exceptional acumen, perseverance, and adherence to a well-defined investment philosophy. His story is not only an inspiring tale of financial success, but also a blueprint for aspiring investors seeking to navigate the complex world of the stock market and achieve lasting wealth.